Income tax. Income tax is the most basic one. When you earn money, from a job, a business, or freelance work, the government takes a percentage of it. That percentage is your income tax. The more you earn, the higher the percentage you pay. Tax bracket. A tax bracket is a range of income that gets taxed at a specific rate. For example, the first $10,000 you earn might be taxed at 10%. The next $30,000 at 20%. The next $50,000 at 30%. Here is the important thing most people get wrong. You do not pay the higher rate on all your income. You only pay it on the portion that falls into that bracket. So earning more never means you take home less. Tax allowance. A tax allowance is the amount of money you can earn before you start paying any tax at all. It is completely free. In most countries this is somewhere between $10,000 and $15,000 per year. Earn below that you pay nothing. Earn above it you only pay tax on the amount over the allowance. Tax deduction. A tax deduction is something that reduces the amount of income you are taxed on. For example, if you earn $60,000 but you can claim $5,000 in deductions, you only get taxed on $55,000. Common deductions include work expenses, pension contributions, and mortgage interest depending on your country. Tax credit. A tax credit is even better than a deduction. A deduction reduces the income you are taxed on. A tax credit directly reduces the actual tax bill itself. So a $1,000 tax credit means you pay $1,000 less in tax. It comes straight off the total. Gross income. Gross income is your total earnings before any tax or deductions are taken out. Net income, also called take-home pay, is what is left after everything has been taken out. When someone asks what you earn, they usually mean gross. When you check your bank account, that is net. PAYE. PAYE is a system where your employer deducts tax automatically from your salary before you ever receive it. You never handle the tax yourself, it is taken at source and sent directly to the government. Most employees worldwide are on some version of this system. Tax return. If you are self-employed, a freelancer, or have income outside your regular salary, you have to calculate and report your own tax. This is called a self-assessment or tax return. You fill out a form each year telling the government what you earned and what you owe. Miss the deadline and you get fined. Capital gains tax. Capital gains tax is paid on profit from selling something that has gone up in value. Sell a property for more than you paid, that profit is a capital gain. Sell stocks for a profit, capital gain. The government taxes that profit. The rate is usually lower than income tax, but it depends on the country. Sales tax. VAT stands for value added tax. In the US it is called sales tax. This is a tax added to the price of goods and services. When you buy something from a shop, a percentage of that price goes to the government as tax. You are paying it every single day without even thinking about it. Payroll tax. On top of income tax, most countries charge a separate contribution that funds public services like healthcare and pensions. In the UK it is called national insurance. In the US it is Social Security and Medicare tax. It comes out of your pay automatically and is separate from your income tax. Tax refund. A tax refund happens when you have paid more tax than you actually owed throughout the year. The government gives the difference back to you. This sounds great, but it actually means you gave the government an interest-free loan all year. A refund is not a bonus. It is your own money coming back. Tax evasion versus tax avoidance. Tax evasion is illegal. It means hiding income or lying to pay less tax. People go to prison for this. Tax avoidance is legal. It means using the rules to reduce your tax bill, things like pension contributions, tax-free accounts, and business deductions. Every financial advisor in the world does this for their clients. One is a crime. The other is smart planning. Inheritance tax. Inheritance tax is a tax on money or assets passed on when someone dies. If someone leaves you a large amount of money or property in their will, the government may take a percentage before you receive it. Corporation tax. Corporation tax is income tax but for companies instead of people. If a business makes a profit, it pays a percentage of that profit to the government as corporation tax. The rate varies by country. This is separate from any income tax the business owner personally pays on their own salary. Withholding tax. Withholding tax is tax that is deducted at the source before you ever receive the money. Your employer does this with your salary. Banks do it with interest payments. Investment platforms do it with dividends. The tax is taken out automatically, you never see that portion of the money at all. Double taxation. Double taxation is when the same money gets taxed twice. A common example: a company pays corporation tax on its profits. Then it pays those profits to shareholders as dividends. The shareholders then pay income tax on those dividends. The same money taxed twice. Many countries have agreements to reduce or prevent this. Fiscal year. A fiscal year or tax year is the 12-month period the government uses to calculate your taxes. It does not always match the calendar year. In the US, the tax year runs January to December. In the UK, it runs April to April. Every tax calculation, every allowance, every limit resets when the new tax year begins.